Financial models have become the most important decision-making tools in finance. FMI is the world's only financial modeling accreditation body. FMI's accreditations empower finance professionals to strengthen and validate their financial modeling skills. Learn more by visiting fminstitute.com today.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about private equity through the cycle with a talented and experienced market participant. Ashmi Mehrotra is a managing director and portfolio manager and global co-head of the private equity group at JP Morgan Asset Management. She also serves on several venture capital and buyout fund advisory committees and is a board observer on several co-investments. Previously, she worked at JP Morgan's internal consulting group. Ashmi serves on the board of trustees of Trinity School in New York City, and she earned her BA from Tufts University. So, Ashmi, thanks for being here on the podcast with us.
Great. Thanks for having me, Rob.
So I'd like to start sort of at the top. There's a lot of uncertainty in the macro environment, although today, strong jobs report, so maybe it's not that uncertain. Anyway, we have several areas of uncertainty around rates. There are a raft of elections this year. Most recently, there was an announcement that there'll be one in the UK. And then there's always a serious question about growth rates in developed markets. So where are you seeing the impact of those pressures in private equity, venture capital, et cetera? And is it creating opportunities that you see?
Yeah, great. We are seeing the most impact in terms of the macro environment is on rates, in terms of what rates, where rates are and how that has impacted private equity and venture capital for that matter, but in particular private equity, because the largest part of private equity is LBOs, leverage buyouts, and the L stands for leverage, and obviously interest rates are a key component of leverage. It has led to a couple of things on the negative side and a couple of green shoots on the positive side, and where we are active and where we see opportunity. On the negative side, it has caused over the last 2 years really a slowdown in overall deal activity and deal volume. Transactions have come down significantly, particularly in 2023. And it's hard to compare anything to 2021 because obviously that was a peak in a lot of ways. But we are still at a very, very low point in overall new private equity investment activity, driven by where the increased rates over the last, call it 2 years. It was particularly acute, like I said, in 23. In 24, it continues to be an issue. However, there has been some capitulation, I think, around it because the uncertainty is it's a little less uncertain, right? We think maybe there's going to be rates higher for longer. Now we saw what the ECB did, but we'll see what the Fed decides to do. But you're in this new environment, and it looks like it has stuck for longer than expected. So sellers have started to capitulate on price, right? Because before it was, well, the buyers were looking at lower pricing to make those same returns given the leverage costs have increased. And the sellers didn't need to transact, so they weren't. Now you're seeing, because of the lack of distributions and exits across private equity, sellers are more open, particularly on the private equity seller side. The sponsors are more open to selling, and you've been seeing more activity of late, particularly in the second quarter. And I would expect that to continue across the year because really they need to show more exits in the portfolio. The other thing that I'd say is that even though leverage costs are obviously much higher than they were, we have started to see more competitive pricing, particularly from the private credit lenders. Okay. Private credits raised a lot of capital over the last 2 years in particular. And many of those firms obviously need to put that capital to work. And if there's less deal activity, well, where are they putting that capital to work then? And so they've become more competitive on terms, on pricing in general, and on terms as well. Obviously attractive for us and for any private equity investor, but that was something that we didn't foresee was going to happen in such a short time frame where spreads have become tighter. Terms are getting more attractive for new deals. So that's also leading to new deal activity.
Yeah, I think it's worth mentioning to those out in podcast land that we're recording this on June 7th, 2024. Exceptionally important because, boy, are things changing real fast.
Real fast.
Yeah, actually just made reference to the ECB rate cut this week. Smaller but psychologically important. Canada also lowered its rate. And we had an exceptionally strong job market, a job indicator this morning. So things are changing. So there's a lot going on. I guess, you talked a little bit about the secondary market is causing a lot of interesting. And I want to drill down into a few things you just talked about. You just went over that, including exits, but let's go to the secondary market first. Are you seeing a good set of values there? Because there's been some repricing in the secondary market. So do you think that the values are looking good now, or where do you see that?
Yeah, so the secondary market has been very active really since 2020 and 2021 and continues to be active this year, driven by, in large part, by the way, because many private equity LPs continue to be over allocated to the asset class. Also because their distributions haven't come back. So the NAVs continue to be where they are and their target allocations are higher than what they would like. So driven by a multitude of those factors, they continue to want to be active sellers in the secondary market. Because there is more transactions, our focus is really on the same type of investments that we've always done, which is small and mid-market secondaries. And overall, I'd say pricing has actually increased. And you're exactly right. Pricing has become more robust for buying positions, particularly in existing buyout funds. Because, well, there's more competition. There's more large secondary funds that have recently gotten raised. And also there's a little bit more, I would say, optimism about, well, where the economy might be going, to your point on the jobs reports and other things, and growth rates in general within private companies. And so I think that is helping to keep it quite a robust pricing environment. That said, there's always opportunities to invest. Private equity is a $14 trillion asset class. So within that, there's obviously dislocations in various areas of it, in our opinion. And one of those is, well, in the secondary market, there are large auctions that take place, but there's also smaller positions that get sold. Sort of one or two like line items that get sold out of broader portfolios that might make sense for the right buyer, where they have an advantage on information or an advantage on accessing those. And we're seeing that's where we're playing more, that's where we're investing more. And that pricing still robust, but it's our job to figure out, well, what is the underlying modeling that we're doing on those portfolios? And we do a lot of extensive due diligence on the underlying companies, and then forecasting where we think they're ultimately going to end up from a return perspective in a potentially less robust macro environment, right? And so we try to be more measured about what that modeling looks like and then come to a price that we're willing to pay. And so we're still being able to transact at what we believe are attractive prices by executing on that type of strategy within the secondary market.
Right. And your area of the market, I presume, is sort of almost always like offers some opportunities because there's such a wide array of sort of range of companies, operations, operators, et cetera. It's all varies quite widely.
Absolutely. Yeah. And what we're seeing on the secondary side, just to give you a little bit more color on the pricing, it's about 91 cents of NAV. So you're seeing a 9% discount on average for buyout funds. This is the latest data. And then on average for venture funds, it's about 68% of NAV. So a lot greater discount, 32%, because it's unclear as to, well, many of those venture funds haven't taken those write downs yet because the companies haven't come back to market to raise capital. So that, and obviously, and potentially they may not get exits for a longer period of time given where the IPO market is today.
Right. That would cause some static in there and give them a little zombie-ish kind of behavior in there.
Yes.
Well, let's talk about exits right now because this is something you all have written a lot about and I think is absolutely fascinating. So, how are the exits looking? Let's try it there.
Yeah, the exit market has been very, very difficult. Every LP will tell you that. If you look at last year versus 2022, the data says that if you look at the amount of distributions received back to an LP relative to the starting year's NAV, it was at 11% last year in terms of how much the portfolio turned over. That was a 15-year low. Our portfolio did more than double that, so we feel obviously good about it. But at the end of the day, the exit market has been very slow, driven in part by the fact that leverage costs are higher and sellers won't have to sell at a lower price unless they absolutely have to. And so that's in one part what's driven the slowdown. The other part has been the lack of IPOs, not just for venture capital backed companies, but also for, large potential private companies to go public, right? The market's been very, very difficult. Last year, there were 17 venture-backed IPOs, and more than half were biotech. Like, that's less than even the GFC. So where do I think we are today? I think it's still going to be a difficult year for exits, even though there has been some seller capitulation, as I said earlier, because you have to show some liquidity if you're going to raise your next private equity fund, by the way, DPI all the way. And so, but still, I think we have to see an improved IPO market. We have to see strategics in particular that are able to acquire companies with regulatory approval, which sometimes has been difficult given, where we are on some of those larger deals. And so I think will it be better than last year or worse? I don't know, but it's not going to be a great year for exits. And it's already started off that way.
Well, just like to square the circle there also, because you mentioned there seems to be growing optimism, but with the exits market where it is, can you connect those things or?
Yeah, I mean, it is, all of these things are so nuanced, but the exit market is certainly not great. And so there's a lot of realism about, well, what can I actually liquidate this year and at what price? But the optimism is related to the fact that the companies in those portfolios continue to grow revenues and continue to grow EBITDA. Right, like actual company performance. And oh, by the way, the public markets, to a large extent, in the sectors that private equity has more exposure to, technology, in particular, TMT, and some of these larger sectors of the economy, I mean, their comps have held up pretty well on the multiples that those companies are held at. And so that's what's leading to the optimism too, is like, well, I haven't seen many declines in my portfolio. I mean, obviously where you value it is debatable at the end of the day, but if the companies are inherently growing on the top line and bottom line through organic growth and inorganic growth, that's what's also giving the optimism, right? And the jobs reports is another indication of that. Like private equity continues to have wage growth, but also job growth in many different parts of where private equity plays. Labor is tight, as we know. And so, but there's optimism in general, just given underlying company performance. And it's not all good, but the majority of it has performed in line with expectations.
Yeah, this is one of the things that's challenging about the sector is the nuance that you just described there. Is it makes it exceptionally difficult from a due diligence perspective, et cetera. But let's talk about tech for 1 second. I mean, it's had a very long run. Some people have called it, late cycle, and it's integral to this optimism. So how are you seeing that?
Yeah, I mean, I'm not, public market tech investor, but I would say and we're very, in terms of how we invest, we look at a diversified portfolio in terms of sector exposures. We certainly have obviously exposure to tech, and we continue to be positive on tech, particularly software as a service and different, more revenue, sticky business models within technology. And I would say that the reason why we continue to like technology is because adoption, disruption, innovation continues at a pace that we have not seen, thanks in part to COVID. Right. But the maybe the growth rate of that adoption has slowed down. But in general, it's still, we accelerated in terms of leapfrog multiple years of that adoption, given where we were in the pandemic. And so JP Morgan, for example, has said at our annual shareholder conference is that we're going to spend $17 billion on enterprise spend this year. Many, many large enterprises are going to do the same, right? Billions and billions of dollars to continue to modernize and adopt AI in particular, right? And so, and both from a consumer perspective and enterprise, but consumers too are continuing to adopt at a faster pace. Mm-hmm. And so we like all of that, of course, in terms of how we invest new dollars. The cautionary item for me would be around valuations, right? AI in particular, I feel that there are very, very frothy valuations for really very early stage companies. And so there will be a shakeout there, as there always is. But we fully believe in this platform shift that's going to happen. It's already happening. It's just that we have to see multiple more kind of examples of true adoption of AI, right, across consumer and enterprise.
Right. Also, some of those fallouts from AI came a little bit sooner than some of the other shifts that came along. So, I wonder if the accelerant portion of COVID is still having some accelerating effect on this now. So, so this is exceptionally interesting. Thank you very much for sharing your views here. If to you listeners, if you like what Ashmi had to say and you want to hear more from her, I'm really happy to say that JP Morgan and CFA Society New York are working together on an event in New York City on June 17th and 18th, which is hosted by Alts New York. if you are a member of CFA Society New York, you should know that if you register, your membership will get you a very solid discount to that event. And if you have not joined CFA Society New York yet, and you're planning on going to Alts New York, you should definitely join now because the discount basically makes your membership free. So, so thank you again, Akshmi, for being here. We'll see what you have to say next week at the event. And thank you all for listening to this podcast. Until next time, I'm Rob Rowan, and this has been Compound Insights.